Hello and welcome to this month's market update. I'm joined by Cadence Ho, member of our Capital Markets and Asset Allocation team. Welcome, Cadence.
Thank you, Carlo.
So let's begin with the US trade policy. What's the latest there from the changes announced?
So there's been talk about US trade policies and the tariffs that the Trump administration might implement. We've seen previously when Trump was elected, we've assumed that the Trump administration would want to avoid any direct trade conflicts coming out with its trading partners, especially China, but recent communications and development have led markets to question that. And what we've seen with estimates is that with US tariffs, even a contained but slightly significant increase in tariffs will actually put a modest decline in growth in the near term, as well as inflationary pressure in the US in the short term.
So we'll see if there's any more announcements there. And how about in Europe? With some improvements there, the ECB likely to reduce their bond buyback program?
So within Europe, when we look at the macroeconomic conditions and indicators, it's continued to suggest that it's a positive outlook in the near to medium term. We've seen inflationary pressure on the demand side continue to sustain its increase, but supply side inflation has actually softened since its high in November last year. So business surveys have continued to suggest momentum in activities such as your manufacturing side and services side has continued to sustain its high level, even though it's marginally weaker than the later half of 2017. Overall, we've looked at what the ECB has announced, and they've confirmed that in order to actually reduce their bond buying program, they will need to see a sustained inflationary pressure throughout the entire economy.
Great. We'll wait and see what happens there. And over in the emerging markets, China's made some announcements about their constitution. What's the likely impact there?
So within China, there's two major reforms or constitutional changes that has been announced in the last couple of weeks. The first one would be they've came out to announce a growth target for 2018 at 6.5%. The next one would be they abolished the term limits for its presidency. So on the supply side, when we look at what the reforms that they've been pushing through, that's actually a positive. But when we look at the political risk, that remains to be seen how the presidency and the political risk will play out, especially with the trade rhetoric that's coming out from the US.
Okay, so we'll monitor the political implications there. And how about in the domestic market? Is there any updates on Australia for us?
Within the domestic market, indicators have continued to suggest a growth in momentum. The labour market has continued to strengthen with jobs growth coming out strong. One of the key concerns would be wage inflation, where it continues to remain muted. So that's a key area for the RBA to keep watch and assign when they will start to raise rates. When we look at GDP growth that's been announced in the last couple of weeks, growth has actually slowed down from its long-term average. But even though it's marginally weaker than expected, the pickup in consumer spending has actually made up for the net drag in exports, as well as the slowdown in construction activity coming from the housing sector. So on the whole, that's a positive light that remains to be seen how it will pan out in the longer term. When we look at inflation, for example, inflation has continued to remain marginally stronger. So on the whole, when we look at the domestic front, it's well balanced and growth momentum remains strong.
Great. Well, hopefully we see some more continuing momentum in Australia. Thank you very much, Cadence, and thank you to you for joining us.